Most Singaporeans turning 55 this year will leave 47,000 Singapore dollars in compounding returns on the table. It is one avoidable CPF decision that causes your ordinary account to bleed when a 3.8 times interest coverage ratio misses the 4.0 mark and that 4.8% yield turns out to be fake. Today, I am showing you the 3 things I check before I move a single dollar of my retirement capital. Your ordinary account pays a guaranteed 2.5%. That SGX listed stock you are eyeing might offer a 4.8% dividend yield. And that 2.3% spread looks like an easy win for your retirement income. But there is an uncomfortable number your broker is not showing you. If that company's interest coverage ratio is below 4 times, that is the number of times their earnings cover their interest payments, you are not just investing. You are subsidizing their corporate debt with your retirement sanctuary. We need to audit these moves with forensic precision before we touch a single dollar of that ordinary account capital. Before we get into the numbers, I want to be clear about who this analysis is for. I am doing this for the retiring and retired Singaporean who needs their capital to work reliably, not spectacularly. We are looking for sanctuary assets that provide a steady floor for a household in Bedok or Jurong. When you are in the drawdown phase of your life, the risk of a distribution cut is not a line on a chart. It is a direct hit to your monthly grocery and utility budget. In the decades before your 55th birthday, your special account is the primary engine of your retirement fortress. The special account rate currently sits at 4.0%. That is the risk-free floor for every Singaporean investor. To understand the gravity of moving funds outside the CPF system, you need to calculate the risk premium. That is the 4% special account rate minus the current 6-month T-bill yield. The smaller that spread, the less you are being compensated for taking on any market risk. Moving ordinary account funds into SGX bypasses your option to transfer those funds to your special account where they earn a guaranteed 4%. Our 4% floor is a fortress, and the global context makes that clear. In the United Kingdom, the state pension offers no guaranteed interest on balances. It relies entirely on a payout mechanism. In Australia, the superannuation system is fully market-linked, which means your balance can actually shrink during a downturn. If the special account rate dropped by 10%, a household with $200,000 in their account would lose $800 a year. Over 20 years of compounding, that oversight totals 16,000 Singapore dollars. Every dollar you move out of this environment must work twice as hard in the private market just to break even. At 55, you hit the pivot point. Your ordinary and special accounts merge into the retirement account, and that is where sanctuary assets can get quietly downgraded. The special account closes, and overnight your liquid cash drops from 4% to 2.5%. The choice between the basic retirement sum, the full retirement sum, or the enhanced retirement sum is the most significant financial decision you will make. Choosing basic over enhanced can mean a difference of over 1,000 Singapore dollars a month for life. The supplemental retirement scheme offers a parallel pivot for your strategy. You get a 50% tax exemption on withdrawals starting from the statutory retirement age if you spread them over 10 years. If you withdraw 40,000 Singapore dollars a year, only 20,000 is taxable. But you must run a forensic check on these funds. If your SRS money is sitting in a bank account earning 0.05%, you are paying for the privilege of losing purchasing power to inflation every single hour. Your SRS investment must yield more than the cost of that lockdown. Most heartland investors focus on the extra 2% yield they might get from a REIT compared to leaving money in their ordinary account. In doing so, they often miss the silent erosion that happens when the special account closes at 55. By failing to shield their special account before the retirement account is formed, they allow their highest yielding assets to be downgraded without realizing it. The cost of that oversight over a decade often exceeds the total dividends received from their entire stock portfolio. A high yield on a small capital base is a vanity metric. A guaranteed 4% on a massive sanctuary base, that is a retirement. At 65, we move into the drawdown architecture and look at the SAN score. This tests whether your combined income floor from CPF Life, SRS drawdowns, and SGX dividends covers your monthly expense baseline. A retired couple in Tampines who needs 4,000 Singapore dollars a month but only receives 1,600 from CPF Life faces a forensic gap of $2,400. To bridge that gap using SGX dividends at 4.7%, they would need over 612,000 Singapore dollars in invested capital. This is why knowing your income floor before you stop working is not optional, it is the whole game. The sequencing of your drawdowns matters just as much as the amount. Draw from your SRS first to maximize that 10-year tax window while letting CPF Life stand as your lifelong hedge. CPF Life is a public utility annuity with some of the lowest administrative costs globally, unlike the expensive and opaque annuity markets in places like the United Kingdom. If your SAN score fails, the data points to one of two problems: you are overexposed to market volatility, or you have underfunded your CPF life tier. You never want to rely on variable market income to pay for fixed survival costs. Your retirement fortress should protect your heirs, not become a bureaucratic hurdle for them. A CPF nomination is your will for these specific funds. Without a valid nomination, your funds are handed to the Public Trustee's Office under intestate laws, administrative fees, months of delays, and unnecessary grief for your family. For a balance of 100,000 Singapore dollars, that lack of a nomination could cost hundreds of dollars and months of time. One simple step keeps your sanctuary intact for the next generation. The policy landscape is always shifting. The most recent budget raised the enhanced retirement sum limit to 4 times the basic retirement sum, up from 3 times. This opens the door for higher voluntary top-ups and a larger lifelong monthly payout for 55-year-olds with excess cash. For a resident in Toa Payoh, that could mean an extra few $100s in their monthly check. But there is an uncomfortable truth. Every dollar you lock into the retirement account at this new ceiling is a dollar that cannot be accessed for emergency liquidity. You are trading flexibility for a guaranteed floor. Know what you are giving up. Let me show you what these numbers look like in practice. Mr. Tan is 58 years old, living in Ang Mo Kio. He has $150,000 in his ordinary account and $80,000 in his SRS. Even with CPF Life and SRS drawdowns totaling over $2,000 a month, his SAN score fails. His estimated expenses sit at $2,800. He is facing a monthly deficit of nearly $400. He is considering putting $50,000 into REITs, but even at 4.7% yield, that only generates about $195 a month. He is still short, and he is taking on market risk to bridge a survival gap. If you want to see the live SAN score calculator I used for Mr. Tan's audit, it is available right now for Iggy's elite investors. Members get 0-day access to the full forensic spreadsheet and the automated yield floor tracker. Check the link in the description to upgrade your analysis. I always apply a conservative 3.2% floor when planning. We plan for the storm, not the sunny day. Interest rates fluctuate, but I do not lower my standards to match a temporary dip. My floor stays at 3.2% to ensure sanctuary assets can withstand a return to long-term average rates. That means the minimum yield hurdle for any SGX holding in a retirement portfolio is 4.7%. My 3.2% floor, plus a mandatory risk premium of 150 basis points to compensate for leaving the CPF system. Mr. Tan's plan looks close, but he is missing the silent risk of interest coverage ratio decay in his REIT portfolio. If the REITs he selects have a ratio trending toward 2 times, a higher for longer rate environment could force a distribution cut. That $195 monthly dividend drops to $130. His monthly deficit widens to nearly $450. Never use variable dividends to pay for fixed survival costs. That is exactly what the CPF Life Floor is designed for. Before you move a single dollar out of your CPF, run this strategic checklist. First, check if your retirement account is on track for the full retirement sum, which is 220,400 Singapore dollars for the 26 cohort. The difference between basic and full is $600 a month for life. Second, ensure your target company has an interest coverage ratio of at least 4 times. Third, verify that any REIT gearing is below 35%. If a company cannot service its debt or is over-leveraged, your dividend is not a return on capital. It is a return of capital wearing a disguise. In the world of dividend investing, we spend a lot of time talking about the yield spread, the difference between what a stock pays you and the risk-free rate. But there is a hidden leak that most retail investors completely ignore: transaction friction. If you are deploying $10,000 into a Singapore REIT and your broker eats a chunk of that in minimum commissions or platform fees, you are starting your investment in the red. Data is only useful if you have the tools to act on it without getting eaten alive by those fees. That's why I use Longbridge. They are currently the only platform in Singapore offering lifetime $0 commission circumflex for US, HK, and SG stocks. Their data visualization is also some of the fastest I've used, which is critical when you're timing an entry in a volatile market. To help you plug that leak, I've partnered with Longbridge for a specific pilot program. For the first 10 readers who open and fund an account with a minimum of $10,000, they are offering a direct $100 cash credit on top of their generous welcome rewards. Simply put, if you deposit $10,000, hold it for 3 months and complete 5 buy trades, you will receive an exclusive $100 cash coupon, $300 worth of Nvidia shares in total, as well as a 10% interest boost coupon valid for 180 days valued at $98. Why does this math matter to a forensic investor? Because $100 on an $10,000 deposit is an immediate 1.0% day 1 yield boost. It is the simplest way to neutralize transaction friction and protect your margin of safety before you even buy your first share. This is a one-time pilot strictly limited to the first 10 spots. Link and full terms are in the description. Other fees and terms and conditions apply, so read those first. But for a forensic investor who cares about entry cost, this is worth 5 minutes of your time. This video is a paid partnership with Longbridge Singapore. It is intended for general awareness and does not constitute investment advice or a recommendation to buy, sell, or otherwise engage with any investment products or financial services. The presenter is not a licensed financial advisor and is not offering financial advice. All views expressed are solely those of the presenter and do not necessarily reflect the view of Longbridge Singapore. All investments carry risks, may not be suitable for everyone, and you may lose your investment principal. Past performance is not indicative of future results. You should seek independent financial advice if you are unsure about any investment decisions. This advertisement has not been reviewed by the Monetary Authority of Singapore.